Rav. Welcome to the Everyday Investor, the hottest real estate show in the world. That's right, I said it. I don't care who knows it. We've got a great show lined up today. Make sure you get your pen, your paper, your calculator, all that kind of good stuff, because we want to take some notes and learn how we can make money investing in real estate, particularly in properties is this segment. You always want to ask 4 questions to start when anybody introduces an investment opportunity to you. The first question is, what's the return on investment? What's my ROI? Secondly, when do I get that ROI? If somebody says it's 20%, but you get it in 5 years, then really it's only 4% annualized. So you want to make sure, when do you get that ROI? Number 3, what is the investment amount? How much is out of pocket to be able to get into this investment? And number 4, you want to look them right in the eye and ask them, what is the risk, the worst case scenario? The one that protects me always from worst case scenarios. My co-host today, the guest co-host, Anthony Maniaci, is in the house. Anthony, thanks for being here.
Happy to be back.
Anthony is a lawyer extraordinaire, real estate, corporate law. Anthony, it's good to see you. I know you're really busy. You're actually taking the kiddies in a few days to Disney.
Yep.
How old are the kids?
Where are we at now? 7, 5, and 3.
7, 5, and 3. So your wife has 4 kids to take care of.
You got it.
You being the 4th. Nice. So listen, we always talk about real estate investing. You're an avid investor as well, and I whenever I'm speaking live, whether it's on TV, I always want people to understand that this is really just a tool. It's just really to help to be able to go to Disney with our family and friends. It's to be able to help, to be able to enjoy family and friends, to be able to do something benevolent, charitable. Touch on that. The reason why I love having you on the show so much is because you think obviously the same way. There's spiritual connotations. This is not about just making money. It's about really enjoying life and being able to have the time to enjoy life.
Well, it's that holistic approach, right? I mean, when you sit down, you look at how you want to structure your life and how you're able to do what you want to do, and being able to use the real estate in and of itself and the various different vehicles within there, whether it be mortgages or investment properties and the like, to have these alternative streams of income so that you're not wholly dependent just upon your paycheck or your weekly draw or whatever the case may be, depending on where you work. So having these alternate streams of income, yes, it's more work, but that's a part of the deal, allows you to at least the way I look at it, feel a little bit more comfortable as you go through and hopefully be able to ride some of the difficult times. And
you say more work, and it doesn't necessarily have to be a lot of work. It depends what type of investment that you want to get into. I mean, we talk often on the show about active investments, and then there's passive investments. And I know you invest a lot passively. You don't do a lot of work. You make sure that things are done properly on the front end, and money just kind of comes in. I mean, as people have been watching this show, I think we've been doing this for 11 years now. Can you believe it? There's many different real estate investment vehicles, whether we're doing land deals, whether we're getting into mortgages, REITs, mix. Today, specifically, we're looking at investment properties. It doesn't have to necessarily be a lot of work if we are doing a lot of due diligence up front.
But that sort of encompasses what I was talking about, and part of the work is doing the upfront education to get yourself in a position where you can feel confident moving forward. The worst thing you can ever do is to walk into something blind, especially investments of these sorts where the dollar values are 5 to 6 figures, and as a result you want to make sure that what you're doing and how you do it, quite frankly, is done well thought out, goal oriented, with your team of advisors behind you, helping you each step of the way.
Yeah. Well, if I haven't said it before, I thank you for helping me with all my investments, getting some great counsel from you. There is a lot of people, and probably myself as well in the beginning stages, where we came to you after the fact. And that doesn't really, it's not like you can wave your wand across it and say, okay, I'll fix it, Rav. We really need to understand that, whether it's our accountant, whether it's our realtor, our lawyer, we have to build our team before we get involved in this and be able to present deals. There's probably been a lot of nightmare stories where you really just wish you could help your friends out, or clients, or to-be clients, but it's a little too late because they didn't come to you first.
Correct. It happens more often than I'd like to admit. It's not much you can do about it. I always tell my clients, it doesn't cost you to make a phone call. Period. End of story. So there's really no excuse for you ever to stop, put that pen down before you sign something, and make sure that what you're doing fits within the broader scope of your overall objectives.
Yeah. I was, again, whenever we kind of teach real estate investing, people come up and say, Rav, why is not everyone doing this? Well, it's because there's a lot of headlines. There's a lot of people writing articles, and a lot of are legit and a lot aren't. I'm seeing in the GTA some things going sour. I mean, just of last week, there's, we won't mention names, but there's big developers. There's, different types of investment funds that are going south. What would you say to that? Is there ways in which
due diligence and asking around? I tell all of my clients before they enter into, get references, speak to people who are no longer with that investment, because the references that any kind of company might provide to you probably will be positive references. They're not just going to forward to people who'd had negative investor experiences wherever they may be. So you really have to dig in, check the web, check around, talk to your lawyer, because again, a lot of times there's little canaries in the coal mines that we in the industry might be aware of to say, you might want to back off here and go over here, or whatever the case may be. But it is so vitally important to really do a thorough background check, not only of the company that you're investing in, but the principals within that company, to make sure that you're comfortable giving them your money.
That's a great point. So not just the investment vehicle, but who runs that company, do some history on them, if we all have could have hiccups, find out, okay, I read this with this particular deal, can you explain what happened, and so on and so forth. And I think a lot of times we have to go with our gut, right? Just our normal, natural intuition. So Anthony, are you seeing a lot of this? Is it increasing more and more because everybody's trying to make a buck here, or?
I'm definitely seeing people look around the marketplace for these newer type products, especially within the real estate space. You have a lot of developers who might go out through syndication or otherwise to look for money, but you really, really got to know what you're doing, and especially these syndication type products. For the most part, I advise my clients, against them. I'm a little bit more comfortable playing in the mortgage space and doing things where the security and the control is a little bit greater. So again, it really comes down to the individual investor, client, what their goals are, what their risk tolerance is, and what their level of sophistication within this marketplace is. Because you may be very good within the stock market world, and you may understand the game and how it's played, but have no clue how the real estate market works in Ontario, more specifically the GTA. So you really got to know what you're doing.
Yeah, and I think people are just, they look at their RSPs or whatever it may be, 2-3%, or their GIC. I don't even know if you make a point on that, but making a percent on that. And then they see something that might be 8, 9, 10, 11, 12, 25, 30%, and they want it so badly, and they jump in, and then there's a kind of the scarcity effect. If I don't get in now, I'll never get in.
There's a salesmanship aspect to that too, right? There are people that you're going to meet with that will put the sales pitch on you for sure.
Hold that thought. Let's go to break. We're going to be back with my good friend Anthony Maniaci and some everyday investors. You don't want to miss this show. The Everyday Investor continues in a moment. Thanks for watching. Hey, it's Rav. Welcome back to the Everyday Investor. Before we get to my next guest, we're going to be talking to our mortgage expert extraordinaire, Carmen Capanero's on the phone. Hello, Carmen.
Hi, Rav. How are you?
Good. How are you?
Great.
What's happening in the world of mortgages? I think you've been traveling a little bit. You were in Florida again for a little while?
Yes, I was. Then it was a well-needed couple of weeks off.
Yeah, well, listen, I'm looking forward to you coming on. You're on the show next week, so that's exciting. But what I want to know is what's happening with mortgage rates? We're still at historic lows. Should we go fixed, variable? What are your thoughts?
You know what, Rob? It's the same. The rates are low. They remain to be low, and they predict that it will be for the next couple of years. So I think people should be, ultimately, my suggestion is variable rate mortgages. I always use a variable rate mortgage.
Yeah.
And why? Because if you ever have to make a change in life or sell or something, that you're not locked into an interest rate differential when you have to pay out your mortgage. So for me, you're only going to be obligated to a 3-month interest penalty on a variable versus paying a huge penalty if you go with a 5-year and you have to sell. So plus it's been the lowest rate in the last 10 years.
Yeah.
So I think variable is the best way to go.
And Carmen, when we're looking at lenders, different lenders, you're a mortgage specialist, pro funds. How many different people do we get to talk to when we go with a mortgage specialist such as yourself?
Well, yeah. So if you're purchasing a property or you're refinancing, when you deal with a mortgage broker or our company, you are able to reach probably 20, 30 different lenders with one credit inquiry. So I think that's what you're referring to.
Absolutely,
So,
as opposed to, you know, one of the big five or whatever.
exactly. So if
Yeah.
you go to one of the big five or an institution on your own,
Yeah.
that specific lender is working for the bank, not for you.
Yeah.
And if they decline it, that's it. That's the end of the road there, and you have to go to the next person.
Yeah. Okay.
So,
Well, listen,
program's very
great advice, and look forward to having you on live next week.
great. We'll look forward to that. Can't wait to see you.
Okay, you too, Carmen.
Okay,
Thanks.
Thank you. Bye-bye.
Bye-bye. You know, Anthony, there's a lot of talk about that with mortgages, and they're up and down, and they're historic lows, and should I lock in? And you can even lock in for a 10-year right now. What's your thoughts? What do you do with your properties?
Just like what you heard Carmen say, variable, variable, variable. I personally like the flexibility as she talked about. I find the penalties on fixed mortgages can be just absolutely catastrophic for people. I'm seeing it time and time again.
Yeah.
And the issue really becomes, well, today everything is hunky-dory, and you think you're going to last the 5 years or the 4 years of the term of your charge.
Yeah.
At the end of the day, you know, life throws you curveballs, and you never know what you have to deal with, and you don't want the unexpected hit of a penalty that can be in the tens of thousands
Which
as
they
a result
are.
of
Yeah.
interest rate differential. So, big fan of variable. I see the rates not really doing much because of the way the economy's sputtering. So,
Okay.
there's no real reason
Great
to go any
advice.
other way.
Well, listen, Grant McDonald's on the show here with us.
Yeah,
It's
thanks for
so
having
great
me.
to have you. For you watching at home, Anthony, this young man, 24 years old, his goal is to have 24 tenants, and he's already at 20.
Yes.
You already have 20 different tenants. We're going to look at one of your properties that you just acquired, a duplex. Let's go through the numbers for a second, and then we'll talk about you know, just your mindset when it comes to real estate investing. But I think that's fascinating. You know, you are definitely a good catch for somebody out there, a young single man, 24 years old with 20 tenants, and your goal is to hit 24. But then, of course, you're going to try to keep going after that, I'm sure, or maybe you're not.
Yeah.
You know, sky's the limit for you.
Sky's the limit.
Yeah. Okay. So let's take a look at a property that you just bought. So this is a duplex. So a duplex, what does that really mean? You got kind of two tenants for one furnace.
Yes.
Kind of thing.
Well, we actually did a major renovation.
Yeah.
So it was a beautiful old century home.
Yeah.
Pretty well got job. Unfortunately, it was neglected.
Yeah.
So during the renovation, it was gutted. We figured might as well put, you know, 2 different electrical panels, 2 different furnaces.
Wow.
That way they're on their own.
Fantastic. And where was this property?
This is actually up in Peterborough.
In Peterborough.
Yes.
And you live where?
I live down in St. Thomas, just south of London.
So you live south of London, and this property is in Peterborough.
That's correct.
So it just goes to show, Anthony, you don't have to invest in your own backyard. You go where the money flows.
As long as you educate yourself and you
Yeah.
do your homework.
Fantastic. Okay, so run me through some numbers here. The first question we always ask whenever we're looking at an opportunity is, what's the return on investment? So you kind of ballpark knew, now that you've done it, what is the return on your investment on this property?
The ROI on this was 75%.
75%. Seriously?
Yes.
So 75%, and that's on the first year, annualized.
Annualized, correct.
Okay, so basically you put $1 in, you could get your dollar back plus 75 cents.
Yep.
Is that a good return, Anthony? For a young 24-year-old?
Phenomenal.
That's phenomenal. So how do we do this? Walk me through the numbers. Let's teach the viewers, you know, at home how we did this. So what was the purchase price?
Yeah, 110,000.
110,000, and then that's why I understand why you went to Peterborough.
Exactly.
So you went $110,000. That was your purchase. Okay. And what do we do to this then? So what are we in for? What percent did you have to put down?
Yeah, so I did 20%.
20%, which
Simply
is
because
what?
I knew I wouldn't be living in this unit. This was strictly for investment, so this was a $22,000 down payment.
Okay, so 22,000 you're in for, and then did you do any lipstick to this? Well, you said a major renovation.
Yes, yeah.
So,
So-
what do we add to that?
Yeah, so well, I factored in about $2,000 for closing costs.
Okay, closing costs. So plus 2K for close, and then for renos,
Yeah, the renovation was $80,000.
80,000.
Yes.
Okay.
So, again, since we gutted it, there was an opportunity to do new electrical. Again, update all the HVAC,
Yeah.
get this thing full turnkey once it's ready to go.
So weren't you afraid to put $80,000? Like, how did you know you were going to get this back?
Yeah, it was just through market analysis. It's beautiful, beautiful spot in the
Yeah.
core of Peterborough,
Yeah.
downtown. Again, a beautiful old home. So there was definitely opportunities, and spoke with some local realtors just to get some estimates in terms of what that value would be if it was revamped.
All the
So,
stuff that Anthony teaches us, to do all your due diligence here. So what are we at? So we're at
yeah, so we're-
104,000?
That's correct.
So you're all in for 104K. All right. So If we're in for $104,000, this property increased in value. So how much did it increase by you doing this work? So $80,000 you're in. So now what was the amount that it went up?
Yeah, about $60,000.
$60,000. So we're going to call that, we forced this to go up $60K. So you're telling me this property is now, you're basically reno, so it's $200,000, so now it's worth about $260?
Yeah.
Is that what you're saying?
Yeah, $250.
$250, so you made $60,000 just on the forced. Then we have natural appreciation as well on that, or
That's
we're
correct.
already calculated? Okay,
Yep.
so then naturally it goes up as well. And how much is that?
$3,300.
$3,300, and what did you use to get that?
Yeah, this is just based on a 3%.
Just a 3% increase,
Yes.
which was normally, that's very conservative, Anthony, a 3% increase. So he's saying his property was worth, $250,000 or so, and then you went up 3%, and so that sounds, just 3% on the 110. Okay, not on the new value, just from the get-go. Okay, great. And then somebody's paying down mortgage.
That's correct.
So we'll call that debt reduction, paying down some mortgage, and how much is that?
Yeah, that's $5,500.
$5,500 for the year.
Yes.
So you're about $400. So when the mortgage and when everything's all said and done, there's about $400 and change going down per month.
Yeah.
So we times that by 12 for the year, and that was what?
Yeah, that there is
$5,500. You said?
$5,500, correct.
$5,500, and then there's a little bit of cash flow.
Yes.
Right. So
Yeah,
that's where you want to be able to go out to dinner once in a while here and there. Of
course.
So after all your expenses, when you get these two rents coming in, the difference is our cash flow. And how much is that?
Yeah, cash flow is $9,500.
$9,500.
Yes.
Wow.
Yeah.
Seriously.
Yeah, again, by doing the electrical, doing the HVAC,
Yeah.
we're able to get them actually on their own bills.
Yeah.
So it's rent plus utilities for both of the
I mean,
tenants.
this is $800 a month basically. You're getting $800 a month from a duplex.
Correct.
That's fantastic. Okay, so what we do whenever we want to find our ROI is you take your profits, if you will, and you divide it by what you're in for. So here we are. What does this all add up to? Do you have that there or no? You want me to do it?
Yeah, I don't
On the
have
calculator?
that one,
Okay, no problem.
have that written
So
down
we've got $60K, $60,000 plus $3,300 plus $5,500 plus $9,500, and that equals $78,300. That's what I have. $78,300. We take this number and we divide that by what you're in for, which is $104,000. And that will equal 75.28% on your money. That is amazing. Fantastic. When we were 24, Anthony, what happened to us?
I was in law school. What can I tell you?
Yeah, you were in law school, and I was with in law as well. Yes, Your Honor. No, Your Honor. Listen, I'm 45 years old, and to see a young man like you, with these kinds of numbers, congratulations.
Yeah, thank you very much.
That's fantastic. And so, you obviously have a team of people that help you.
Of course.
You're in a networking group. That's just phenomenal. Now, with these properties, because you say this is one of them, this is a duplex, and so you're already at 20.
Yes.
So you have other properties, obviously.
That's correct.
But you're a young man, so people are asking, where do you get the money for this?
Yeah, and that's the power of joint ventures.
So explain to me what that is, a joint venture.
Yeah, so essentially there's, a lot of people out there that have funds, whether it's, RSPs or savings or equity in their home, and
Yeah.
they realize that, the GICs and the typical mutual funds aren't doing it for them. So there's opportunities to invest in real estate.
Yeah.
But they might feel as though they're too old to get into that.
Okay, so you needed $104,000 here. So what you mean is, Rav doesn't have any money, but Anthony does. So Anthony says, hey, I don't want to do any work. Grant, I see you're a young man, you're a hustler, you've already proven it.
Yeah.
I'll give you the $104,000.
That's correct.
You do all the work, and what do we do? You can do anything, but generally a 50-50 split kind of thing?
Typically, yes.
So over here, 75%, you would make 37.5%, Anthony would make 37.5%. Anthony's the money guy, and he's making over 35% a year. You're the work guy, you're making over 35% a year. I think that's fantastic.
Yeah.
So this is the way people do business. If somebody wants to contact you to get some more information, they can. They're
Absolutely.
free to do that. Okay.
Yep.
I want to make sure. I don't want to just put it all out there. So what's next? What are you doing next? What you need 4 more to hit your age.
Absolutely, yeah, and it's actually in the works right now. So I've already gone through a property and we're just finalizing some details. So
Finding some, okay, and so, you know, Anthony, we talked a lot about in the beginning, Anthony and I, in terms of there's a lot of work. This is what Anthony's talking about. This
Yes.
is active investments,
Absolutely.
right? This is not passive. Is this your full-time job? Is it going to be your full-time job soon?
eventually,
Yeah.
I do have a full-time job as well. So
Yeah.
it's kind of like balancing 2 full-time jobs. I mean, my weekends are usually, you know, fixing leaky faucets and such, but that's, again, it pays off.
Yeah, and you're doing that to learn because you don't have to fix the.
Exactly.
I mean, you've got a. I mean, when we looked at the cash flow on this particular property, you're making, you know, $800 a month on this, right? 812s, what's that? 96, just shy of $800 a month. I'm sure you could pay a property manager $100 or $150 a month to take care of that property, but you just do it because you love learning and the process right
Absolutely.
now. You don't have any kids to run home to.
Not yet.
At this point.
No, not
yeah.
yet.
Yeah, no. I think that's fantastic, Grant. And so, how did you know about Peterborough? Were you just looking at all different areas, or?
Yeah, no, I was actually up there for a job.
Okay.
I graduated school and moved up there for a role, and I fell in love with the city instantly. The downtown's beautiful. They're pumping a lot of money into the downtown. It's one of those towns where there's actually, you know, lots of shopping and, you know, hundreds of restaurants within walking distance. So
Yeah.
I saw the appeal for that, and, you know, a lack of higher end apartments. There was
Yeah.
lots of apartments out there, but you know, there's a lot of working professionals out there, but just the apartments weren't quite up to par. So
Smart guy. Yeah. Anthony, thoughts?
You know, it's interesting, Peterborough as an actual area to look at. You know, with the highway being extended out to 115, 35, you know, you really got a nice looking uptick in value over time. And I think the most important thing, and it definitely sounds like you're in it for the long haul. And that's the key. If you're able to hold these properties for a little while, and you've done your homework and you understand how the gentrification, which is what you're talking about, sort of is going to work over 5, 10, 15 years. You know, you can make these numbers look like small numbers in the long run, and so a lot of these have to be sort of longer plays. I mean, I commend everything that you're doing. I commend, you know, getting your elbows and wrists and hands dirty and getting in there, because what ends up happening is if you can learn how to manage a lot of this stuff from the sweat equity side, when you get to the point where you're big enough where you don't need to do it yourself, you're going to ensure that you won't be taken advantage of by others who do know what they're doing.
Yeah.
Because you could sit there and say, you just fleeced me on a job that I know that, and so it's part of the education. And the way you're doing it, it's like, you know, these second and third generation families who have these companies, and they make their kids go sweep the floors and things to start, and they move up with the company. The client who's in the crane business, and their sons started as, you're going to go to crane school and you're going to get your ticket. You're
Exactly.
going to learn how to operate the cranes because you need to tell everybody else. And this is a perfect example. And I think it's fantastic, the base that you set yourself up with. You know, you're not a young guy, but it is a young age for anybody to be doing and actively doing what you're doing. It's fantastic. It's just great.
Yeah.
It's great.
No, listen, congratulations. It is so important, if you choose to go down that route, to learn and be hands-on, you know, in terms of what we're doing. Listen, Grant, it's great to have you on the show. You'll have to come back again. I look forward to see what you do in the future.
Definitely.
And thanks for being here.
thank you so much.
Yeah.
Thanks.
Appreciate that.
Grant McDonald, everyone. Stay tuned. We've got another great guest showing us how they're making money investing in real estate properties. Thanks for watching. The Everyday Investor continues in a moment. Welcome back to the Everyday Investor. We're talking to everyday people making money in real estate. Of course, they're extraordinary people, but for the purpose of this show, we'll just call them everyday people. Jordan and Rebecca are on the show right now. Guys, thanks so much for being here. And you guys were watching behind the cameras as Grant was here, and he was, you know, doing some great things. I know that you're 24. Years old still, maybe not Jordan, a little bit older, okay. But no, it's just great to see young people, you know, kind of get into the business. So here we have a wonderful married couple, and you know, that's very cool because a lot of times I'm so blessed to have a wonderful wife who really doesn't, you know, she doesn't want to get involved in the real estate investing, but she's incredibly supportive. It's really awkward, challenging, uncomfortable when one person wants to do it and the other person's not on board. Not only are you supportive, but you actually do this together. So talk to me about that marriage of investing in real estate together. How, you know, is it a lot of fun?
Definitely.
Yeah.
I think it's one of our strengths, really, because as Grant said, it almost is a full-time job doing real estate investing, and we can kind of share the responsibility in that as well.
Okay, great. So who's bolder? Who wants to get out there and just, play the aggressive brute investor, and who's more sophisticated and just kind of looks back at the numbers?
Yeah, I think it's a nice yin and yang for us. I was actually surprised myself a little bit about taking more risk, and Jordan seems to kind of leverage me a little
really?
bit. Yeah, and then there are other times where we're playing each other the other way. So yeah, it seems to be a nice balance.
Okay, cool.
Yeah.
So we're going to look at a property here, and I warn the viewers at home for this one because our return on investment is over 1,000%. Now, hold on, before you change the channel, we're going to show you how they got there, and this is very exciting. So this is a case where we know the area because we grew up in the area and we live in the area, and we're investing right now in Stratford, Ontario. Is that right?
That's right.
Not because Justin Bieber's from in and around there, just because you can make a lot of money there.
That's right.
That's
Is that right?
Yes.
So you're going to show me how you made over 1,000% investing in Stratford. And I think one of the things that we have to address is whenever you're buying an investment property, if you have a principal residence already, meaning the one that you live in, your secondary property, or third or fourth or fifth, you need a minimum of 20% down. But what's interesting here is you guys actually bought this property and moved into it for a short time.
That's right.
And so then therefore you only needed 5% down, correct?
Yes.
And then when you move out, I've actually heard, I don't know if you know this, talking to an accountant, that you actually can move out, and as long as you don't buy another one, let's say you rent somewhere else, this one remains your principal property for 4 years, for an additional 4 years. That's pretty cool.
Yeah.
So you can buy a property 5% down, move out of it, as long as you don't buy something else. So let's say you wanted to move downtown Toronto and rent, this still remains your principal residence for 4 years. So 4 years later, you could sell it and you don't have to pay any tax.
Right.
That's
Perfect.
cool.
Yeah.
Thank you, Canada, Canadian government, for that. So let's look at this property. So we bought in Stratford, Ontario, and why don't you throw me the numbers out? So what did we purchase and for how much?
Purchase was for $275.
$275. And this is single family, or what is this?
It was bought as a single family, and we renovated it into a duplex.
Okay, so you bought it as a single family, and that always adds value when you do something. When you change the use of something.
For sure.
So you took and it probably had all the bolts there, nuts and bolts, side entrance, higher ceilings, all that kind of stuff, or you had to do that.
We added an addition to the property, so we basically doubled the square footage and made it a duplex that way.
Wow. Okay, so purchase price was
$275.
$275,000, and then our down payment was 5% down on that. So what's that? 14,000?
Yeah, just under 14, and with closing costs, it would have been about 18 grand.
$18,000. Okay, so down payment plus closing costs is $18,000, right? That's our down payment, and then we did some renos to this. Obviously, if we're going to put an addition on it,
Yes.
our renos were how much?
$240,000.
$240,000.
That's right.
You bought it for $275,000.
That's right.
Wow. You guys are bold and brave. $240,000. So you're in this deal. Anything else?
No.
So we're in this deal for $258,000.
That's right.
Okay. Out of pocket.
Yes.
All right. Now, is this out of your pocket?
No.
It's not out of your pocket. So you
right.
also, like Grant said, you also had a money partner, a joint venture relationship?
Exactly.
Okay. And is that what you're in the habit of, because you have multiple properties, is that what you're in the habit of doing?
Yeah.
You find money people, you do all the work, they put in the money, and then instead of making over 1,000%, you only made 500% each.
Right.
Shucks.
Is that what you're doing?
Yeah.
That's right.
Yeah, boo-hoo. Okay, so you're in for $258,000. All right, so now we have a forced appreciation, right? You forced it. So what forced appreciation means is, obviously by putting in $240,000 worth of renos, they've enforced the price to go up. So the forced appreciation is how much?
We added $375,000 in value.
You added $375,000 in value. Okay, so this is now the property. The whole property is worth $375,000, $275,000. You're saying the whole property is now worth $650,000?
That's right.
So you added $375,000. Okay, obviously we take some stuff out, but let's just go here for a second. So forced appreciation is $375,000. What else? What's next? Passively, did we use some passive? Just naturally it going up, right?
Yep,
Over
for
a period
sure.
of a year?
So about $20,000 per year in passive appreciation.
And how did you get that number?
That's 3% of $650,000.
3% of the 650 because you changed the value to 650 over a year. We did a very conservative 3%. So passively, what was the number?
$20,000.
$20,000. So you made $20,000 there. And you turn this into a duplex, so you have 2 tenants.
That's right.
So somebody's paying down our mortgage,
Yep.
Yep.
right? So the mortgage is going down each month. And how much is going on the principal of that mortgage under the mattress?
Per year, about
Yeah.
15 grand.
$15,000 somebody's paying off, okay? So you're making that. And then, of course, there is some cash flow here for us to go out on a date once in a while.
That's right.
And so that cash flow, once again, is once all the expenses have been paid out, we have the income coming in from the 2 tenants. The difference should be positive. And what's that over a year?
That's $5,000.
5,000, so about 400 a month. So 5K. So and if I add all these numbers up, is that what I'm doing? Right. So we've got 375, 395, 400, 415. Is that correct?
Well, I was using for active appreciation 135 because I took off the 240 from the 375 because it cost us 240 to make.
Oh, you
the
already
375.
minused it.
That's right. Yes.
You already minused it ahead. Okay, I was going to do it at the end.
Okay,
So
sorry.
no, that's okay. So what did you do for the forced?
Forced, I would have 135.
135 because you forced it to 375, but you want to take out the 240. So you want to know what the pure profit is right there. Okay, so you're going to change this to what number?
135.
135. Okay, so now if I add these numbers up, I get 135 plus 20, 155, 170, 175?
That's right.
Is that right?
Yep.
So your profit is $175,000. Okay, and so now what am I doing? I'm taking 175 and I am dividing it by just the 18?
Yes.
Right, let's try that. Let's see what happens with that for a second. So if I take $175,000, that's how much money I've made just in the first year. And I divide it by now what I'm in for, because we've already taken out the 240, right? So I'm in for $18,000. And that should equal 972%, which is wonderful. It's over 1,000 because you're going to show me something else here in a second. But right now it's 972% is what I got. So basically, you made $175,000 and you're in for $18,000.
Yes.
Is that what we're saying?
Yeah, pretty much.
That's fantastic. That's fantastic. And so if I were to, why didn't you ask me for the money? I would have went and stole the money, given it to you, and I would have enjoyed 500% of my money. I mean, this is insane. I'm talking about in the RSP world, people are struggling to make 4 or 5%.
Yeah.
And you are making, I put out $1 and I'm making, what's that? If it's 1,000 times, I mean that's phenomenal in terms of what we're doing. Now we didn't just leave it here. You refinanced. You pulled more money out.
That's right.
That's right. So the property is worth, what do you say, $650?
That's right.
So let's go over here for a second, and if the property is worth $650,000, then we're allowed to take out. We have to leave in 20% of this.
Correct.
Correct? We have to leave in 20%. So what's 20% of 650?
$130,000.
$130,000. So we have to leave in $130,000, which means you can take out $520,000.
For sure.
So you take out $520,000. Is that what you did?
Yes.
Of the entire property?
For sure. And then that pays off the renovation, the original mortgage, and any other money we had to put in.
Yeah.
And then we're left with only $13,000 in.
You're left with only $13,000 in, which brings you up over 1,000%.
That's right.
Guys, this is phenomenal for you guys that are watching at home. This seems like huge numbers, but really it is. But you can see exactly how they did it. There was no luck here whatsoever. I think what's phenomenal is that you took what they did is they just took a single-family home and they turned it into 2 homes. And obviously, this isn't your first rodeo. You have to know how to do this. But if I'm a money guy, I don't care. I invest with you, and this is kind of what happened. So what's next for you guys? Are we just going to keep going? Like, do we have day jobs, both of us?
We
Yeah.
do, yes.
You both have day jobs?
Yeah. For
sure.
Kiddies right now or not yet?
Not yet.
No, okay, and that's what allows you to be able to move around different homes. Is that your strategy for now? Just put down 5%, live in it for a year or so, move on.
That's been our strategy to start, but we're really open to almost any opportunity that would present itself.
Yeah.
Yeah.
As long as the numbers work.
Yeah, exactly.
Right? I mean,
For sure.
you knew that what your ROI was going to be prior to getting into this. Otherwise, you wouldn't have did it.
That's right.
That's right.
Right? And so talk to me a little bit about how important your team is, because obviously, maybe you did. I mean, did you guys do all the renos yourself, or did you contract out?
Contract most of it out for sure.
Contracted most of it.
Yeah.
So how do you find the best realtor, lawyer, contractors? I mean, obviously you're experienced. Have you ever lost doing this, investing in real estate?
Not
No.
yet.
Not
Yeah,
yet.
Yeah.
Yeah, no, and I set you up for that. I knew you hadn't. But how do you find the best people in the business to be able to help you?
Yeah.
Is it hard?
Yeah, no, it's can be a challenge for sure, but it's great when you have a network of other people doing the same thing, and you can bounce ideas off of them and see who's been good for them as well, and make contacts that way.
Yeah. Well, listen, I think it's fantastic. And do you like to invest right in your own backyard right now, because there's a lot of opportunity there? You're not doing it. I mean, I'm joking when I say you live there and you happen to invest there. If the numbers weren't there, you would go somewhere else.
That's correct.
For sure.
Right?
Yeah.
Yeah, you don't have to just obviously invest in your own backyard, but if you can do both, if you can make money in the place that you live, I mean, how cool is that?
Yeah, it's great.
Yeah. Well, listen, great having you on the show.
Thank you very much.
Thanks so much
Thank
for being
you.
here. Very, very inspiring. Rebecca and Jordan making only, about 1,000% on their dollar. That's just fantastic. You don't want to. We have more. We're not done yet. You don't want to go anywhere. The Everyday Investor continues in a moment. Thanks for watching, everyone. Hey, it's Rav. Welcome back to the Everyday Investor. We've had a phenomenal show so far. We're not done yet. Anthony, did you see what I saw on that board with Rebecca and Jordan there?
It's amazing.
1,000%. But we're not done, because we've got the Italian woman. You like Italians, Anthony?
Sure do.
Yes, Maniaci. We've got Nancy on the show. Nancy, it's so great to have you here.
Thank you.
And not only are you doing wonderful things, you only have, not 10, 20, how many properties have we had in the last couple of years?
We have 31 rental units.
31 tenants in a couple of years. Her and her husband, Pepe. And I think that's phenomenal. I'm very excited about this next deal, because you refinanced, you pulled the money out,
Yeah.
and you're actually in for nothing.
Exactly.
So the return on investment is, I don't know what it is. It's infinite, I guess, because what she did is she bought a property, she put more than some lipstick on it, she did all this kind of work, it went up in value, she had to leave 20% in, because that's what we have to do. You leave 20% of the value of the property in, you take everything else out, but that surpassed what she was in for originally. So she's in the deal for nothing, and I think that's absolutely fantastic. So how did we get to over 30 tenants in 2 years? I mean, what did we? How did we start with? Did you start with your own capital, or did you use other people's money to do this? And like our other two guests, we just kind of split the profits.
It was a combination. So the first few properties,
Yeah.
we used our own capital and then kept reinvesting whenever we made a profit.
Yeah.
And then eventually we moved on to joint venture deals and having other financial investors.
Well, and that's smart. And I'll tell you why I think that's so smart, Anthony. I mean, listen, you're not going to necessarily come to me to do your hair. You know what I'm saying? I don't really, unless you want a straight razor.
I do.
I think that I don't know if I would give Nancy any of my money unless I saw her do it first. Now, there's a lot of people that do this, but she used her own money. She had several tenants. They're making a great return on their money, her and her husband. And then obviously you run out, right? Everybody runs out, and that's where you have great partnerships. I think the company that has the most partnerships in the world is Apple, right? Apple has tons of partnerships. And so that's all you're doing. Hey, I've done it with my own money. Money's run out. I know how to do this. Give us, you want Rav to give you your money. I gladly would if my return was 50% of infinite, which would be infinite as well. Isn't that amazing?
So it's phenomenal. And again, it goes to and your structure of reinvesting the profits and compounding your earnings over time. It's staggering how quickly you're able to do things like this if you're not greedy, if you're smart with it and recognize, again, that long haul approach to things. And you're going to end up with stories like this. It's just fantastic.
Yeah, and I want to make sure that you, my beloved viewers at home, who I just feel so endeared to, and really want to give you some great information. I don't want you to think this is pie in the sky kind of stuff. This is the real deal right here in Ontario. It's not the late night, Tom Vu, Rav on a boat type show here. This is the real stuff. And let's go through the numbers here together just to be able to look. So your purchase price on this particular property, that's an infinite return, was what?
$210,000.
$210,000. So we bought this for $210,000. That's our purchase.
Yes.
Okay? And this is what? It's a single, it's a duplex, you turned it into, what did we do?
It was a very large century home that was single family.
Okay, so this is one family
Right.
unit home, and you turned it into what?
A triplex.
I see. So
Yes.
that's the key. So she changed the use. Whenever you change the use in property, Anthony, that's where we make the biggest buck, right? You take some land and you build on it, that's where you're going to make the biggest dollar. She took the land, it had a house on it, but you added 2 additions. So now you have 3 tenants, 1 furnace, and you're making some great money. So that was $210 for an old century home, and that was just west of the GTA, I guess, right? Is that what we
Yes.
said? Okay. And so what happened here? What did we do? What are we in for? You put 20% down?
Yes, I did. So that's $42,000.
Okay, so our down payment, we're in for $42K,
Yep.
and then we did some rentals.
Yes, $160,000 worth.
Okay, so we did $160,000 worth of rentals. That's it? We're good?
Yeah, there's about 3,500 closing costs. But
3,500
yeah.
closing costs. Okay, so let's put that in there as well. So we're 3,500 to close. So that equals 160, 45, 205, 500.
You got it.
Is that right?
sounds right.
So we're in for 205, 500. And again, this money came from an investor. You're an investor, but this money came from a money investor. You did the work, you split the profits.
This was actually ours.
Oh, this one's
Yeah.
yours.
Yes.
Okay. I see what this particular one was
Yes.
yours.
In this
other ones,
instance,
yeah,
yes.
you do other ones. Okay, so you came up with this this money, and we're in. So what are the? So we have forced appreciation.
Right.
We made it go up. We have passive appreciation. It just went up naturally. We have cash flow, and we have the mortgage being paid down. Give me those numbers. So how
Okay.
much did we increase the value of this property?
So the after repair value is $585,000.
585,000. So
Yes.
this, you turned 210, a product for 210, you did something to it, and now it's worth 585?
Yes.
Okay, that's
Yeah.
phenomenal. Congratulations.
So that would be about 211,000.
Okay, so we're already going to take the,
Yeah.
what we're in for out.
Yes.
Okay, perfect. So then our net is what?
211,500.
211,500. Passively, it just went up. You gave yourself what? 3%, 4%?
3%.
3%, very conservative.
Yeah, so-
What's that?
17,500.
17,500. So 3% of the 500 and change
Right.
is 17,500.
Right.
Okay, your cash flow on this triplex?
13,000.
13,000.
Yes.
Making over $1,000 a month
Yes.
in cash flow. Congratulations. $13,000, is that what you said?
Yep.
Fantastic. And then they're paying down the mortgage?
By about 10,500.
10,000. So $900 a month is going under the mattress. We're paying down the mortgage. So what did you say? 10,000?
500.
500. If we add those numbers up, 211, 17, 13, 10, do you have those handy there or no?
I think we've got it 252.5.
252.5. So 252,500. Is that right? 211, that's 30, 40, 41. Yep. 252,500. And then we're in for, not the renos, but we're in for the 42,000 and our closing costs. So if I take my calculator here and I take our profit of 252,500 and I divide that by the 42 and the 3,500, that's 40,000. That's 45,500. 45,500. That will already equal over 500% return if I did my numbers right. But then you did something else different here.
Yes.
The new property value is what?
585,000.
$585,000 is the new property value.
Yep.
Right? We have to leave 20% in. Do you know what that is?
Yes, $117,000 in equity still in the property.
So we have to leave $117,000. So we leave that there. That's what the bank wants.
Right.
And you get to take out the rest,
Yes,
which is what?
$468,000.
$468,000. So you get to take out $468,000, and that is really all your money that was out.
Right.
That was in there, plus some.
Yes, we took $95,000 to the bank.
Yeah. So you made right away $95,000, Anthony. She made over 100 grand. The average salary in Canada is just shy of $50,000. So she paid, her and her husband made the average Canadian salary in 1 year, and this is kicking out these numbers year after year after year, and you have no money in this. Phenomenal. My stomach has butterflies. Did you hear them?
Nothing like playing with house money, pun intended, of course.
Yeah, no. I think this is fantastic, and so this is an aggressive approach. No wonder your company is Pronto Properties.
Yes.
Because once you know how to do this, it's addictive. You just want to keep doing it.
Definitely.
Yeah, no. I think that's fantastic. Anthony, to your Italian sister.
You can't argue with those kinds of numbers. That's for sure.
Yeah, no, I think that's great. So, do you invest really just in the kind of the same area? You're in the Stratford area as well.
Yes.
And
So we're about 1 hour driving distance from us. We're investing in.
Where you're investing in.
Yeah.
And do you manage these yourself, or do you have a property manager?
There are some that we manage ourselves.
Yeah.
We have one 18-plex that we do have it property managed.
You have an 18-plex.
Yes. Yeah.
Like a building.
Yes.
With 18 different units.
Yes.
Wow.
Yeah.
So we'll have to have you back sometime and teach us how you did that.
Okay. Definitely.
Yeah. No, I think that's great, Nancy. And so Pepe, he's not here, but he's here like with you. He's in this
Yes.
game with you.
Yes.
It's not like you just doing it and he's struggling with anxiety at home.
No. So I do this full time now.
Okay, congratulations.
Thank you.
Yeah.
And I call him my money partner.
Yeah.
So he goes to work every day, puts in the long hours so that we can qualify for mortgages.
Yeah. Okay, so he can qualify.
And obviously he gets a say, and we do make decisions together. But
But you did have a full-time job?
oh, I did. I had my own business, which I sold
Yeah.
halfway through last year
Because of this?
Yeah, this makes me way more money than the business.
That's fantastic.
yeah.
And can I ask, what was your starting capital?
So we actually
Because this
had-
was your own, and you needed you needed a couple $100 grand
Yes.
on this one.
Yeah.
And so would you get that from? The equity in your home?
Yes.
Okay.
Yes. So we relocated from the GTA to Stratford.
Yeah.
And there's a difference in housing prices there.
course.
So we made quite a bit of money on our GTA property, and
Yeah.
we put it to work.
You put it to work.
Yeah.
And now you just enjoy. So what's next?
Yes. Oh, sky's the limit. I want to double that number. So maybe 62 by the end of the year.
Yeah, that's amazing. And is your plan, your exit, is to just hold them, as Anthony
Yes.
always preaches, just kind of hold them and just enjoy the cash flow?
Yes, definitely.
I mean, on this particular property, a threeplex, your cash flow is over $1,000.
Right.
Right?
Yeah.
And so I think that's fantastic. I think it's important for people to know, though, that in the beginning, as Grant shared, you kind of have two jobs, right? You kind of have two jobs because you have to wait long enough for your properties to give you enough cash flow to quit your
Definitely.
day job. I don't want people to think that, and sometimes if you just want one or two properties.
It's entrepreneurship 101. Anytime you start a business, no matter what it is, you got to keep your day job while you're getting that off the ground. I mean, it's absolutely.
Yeah, I don't want people to think that, because there's a lot of people that buy one or two properties, and that's phenomenal. And, over 20 years, it pays for their kids' education, it helps with their children's down payment, it gives them some cash flow, all that kind of stuff. 1, 2, 3 properties is great, but you won't quit your day job.
Right, this is a
right?
growing concern. This is a totally different ballgame.
Yeah,
for
this
sure.
is a different sheet. Nancy knew what she wanted to go, hence Pronto Properties, over 30 different tenants in a couple of years. So you obviously have a strategy in place.
Yes.
And so if people want to learn more, they can get a hold of you there on the email you. And,
Yes.
whether we want to learn how to do this or we say, hey, can I partner with you because I wouldn't mind infinite
Yeah.
returns as well.
Yeah, we'll do all the grunt work, and they can just be our financial partner, very passive.
Yeah, no, that's fantastic. Anthony does that a lot. He's busy with his 3 kids and then invests in different things, whether it's the movie industry or mortgages or properties and all that kind of stuff. But I think it's just so great, Anthony, just to see, as extraordinary as these guys are, just everyday people saying, hey, I can do this.
Rav, I chose my words carefully before when I mentioned the term entrepreneurship, and I did that on purpose. Because, anybody can do this as long as you're willing to put in the time, the effort, and get out of it, what you put into it, like anything else. So, more than anything else, educate yourself and get out there. I mean, this is a 2-year proposition. It's phenomenal.
Yeah.
And to have that kind of an arc on your new business venture, Anybody can do it.
Yeah. No, I think it's great. What are family and friends saying? It's only been 2 years, right? So
Initially, they thought we were crazy.
yeah.
Always.
But now they're impressed.
Yeah.
They're, you know, we've got family asking about investing. And,
Yeah. And you have a network, right? You're with Keyspire, keyspire.com there, and that's a great network of investors that share ideas, and
Yep.
you know, so I think that's very important, because when you have a lot of not rejection, but when you have a lot of, hey, you shouldn't do this, you know, we call them they sit by their pools and give you all the advice,
negative
but
Nancy's.
yeah, exactly. But you know, you stick with your own people, and so congratulations.
Thank you very
Yeah,
much.
fantastic. You're watching The Everyday Investor. It's been a phenomenal show. You don't want to go anywhere. We'll be back with Anthony's closing thoughts. Thanks for watching, everyone. Hey, welcome back to The Everyday Investor. We've had a phenomenal show. Anthony Maniaci's been here throughout the whole thing. Anthony, what do you think?
You know, it never ceases to amaze me when we bring people on this show, just how quickly they're able to achieve these gains and the staggering numbers if they follow the process that's been set up by this networking group, or the Keyspire group, and so forth. I find it's a very sound approach to investment. Anybody out there, look, you know, with investment, there's always risk. When you're getting these kinds of returns, you need to know what you're doing to mitigate that risk. So I always, you know, will always say to you out there, make sure you've educated yourself. You get on the phone with a guy like Rav, talk to your accountant, talk to your lawyer, mortgage broker, to ensure that you have the numbers in place and there are no surprises, because I think any one of these guests will tell you the worst thing in the world you can have when you have these kinds of properties are the unintended surprises that could have been avoided had you just done some work on the outset. So,
Yeah.
I mean, man, oh man, what numbers we saw today. That's just incredible.
Yeah, and you know, with a lot of, as you said, with a lot of due diligence, a lot of work, you know, people can do this, right? It's the real deal. It's not pie in the sky.
It's not easy.
Yeah,
But
no.
it can be done if you put in the elbow grease.
Yeah. Listen, have fun in Disney with the family.
Will do.
That's more importantly, family and friends.
Always.
And to my guests on the show, I mean, I know they believe that as well. So thanks for being on, and I can't wait till you're on with me again. Fantastic. All right, everyone, on behalf of Rogers TV and myself, Rav Toor, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. Ciao, everyone.